doesn't necessarily care if you just had the best year ever for your company. What they want to know, and what buyers, acquirers want to know, is this sticky? Is this going to last? Or did they just get lucky? Your answer to that question and how well you can substantiate that will have a material impact on how much your business would be valued for should you decide to sell it after you had that amazing year. I'm Arthur Petropoulos, Managing Partner and President here at Hillview Partners. We're a middle market investment banking firm selling companies across all industries. We've sold $1 billion plus of companies, and we have done so many deals that we will guarantee that in any new engagement, within 100 days, we will have offers for any company looking to sell. So to today's video, if you've just had the best year that your company's ever had, how do you ensure that that is captured in the value when you sell your business? People are going to say, acquirers are going to say at times, oh, well, of course they're trying to sell now. They just had the best year ever. Oh, they're never going to do that again. Oh, they had a really lucky year. Now they want us to pay a multiple on that. And the answer is, yes, we do. But how do you substantiate that? Historically, private equity firms, strategics would look at an average of the last 3 years worth of pre-tax profit or EBITDA. However, if your company has done X, Y in terms of profitability, if they applied the same multiple to either an average of the last 3 years, so if they said we're going to pay 6 times the profit of this company, if the company did $1 million, $5 million in pre-tax earnings, they'd say, okay, 7 divided by 3 is 2 1/3 by 6 times. We're going to pay $12 million for the company. We'll try to illustrate this as we chat on it. Or if you could substantiate that the $5 million of EBITDA was here to stay, and they applied a 6 times multiple to that, that's $30 million. So it has a huge impact on the ultimate value of a business. Now, how do you substantiate those things? We think there's 3 ways to do it, 3 concepts to think about. 2 kind of in the presentation of the materials and of what you are selling, and the third being an element of a deal that can help substantiate or that can help secure that type of evaluation. Item number 1 is going to be substantiating sales changes. And what we mean by that is if there was something to do with the sales process, so if a business is made up of sales and execution, getting business, doing business, if the getting business part of the business has changed in some defensible fashion, in some way that it's not going to go backwards, then you need to highlight it. If you say sales grew by X%, which led to EBITDA doubling this past year because we hired 5 new salespeople, because we made X amount more outbound emails, because we utilized X more paid ads, postcards, whatever the means of sales. But if you can define, we've gotten more shots at the basket and therefore more pull through into clients, therefore it's not going to go backwards. We have built the sales machine to a larger degree such that we're not going to have a reversion back to the numbers as they used to be. Then you can substantiate that this is not a fluke, this is not luck, this is just the way the business is now. Secondly, number 2, is substantiating changes in execution. Oftentimes the increase of capacity. And what we mean by capacity is, let's say you are in the business of providing a service, you are in the business of making a product. When you get orders for those things, or when things come out of the sales process to you, you are going to do the thing, provide the product, do the service for customers. If historically you had a bottleneck of more sales than capacity to service those sales, then by saying we have unlocked it, we've hired X new crews to do the work. We have hired 20 new people in the office to do the stuff. We have brought in AI, software, automation, delegation, whatever it is. But if you have a story as to we're not going to fall behind on servicing demand, the supply of what we have is going to keep up with the demand, then again, you can say historically we were bottlenecked because we didn't have the execution capacity. Now we do. We are not going backwards. And so again, if you can substantiate sales, that we are getting more sales because of these definable, very explicit things, and or because of execution, we now have the capacity to do more, to chop more wood, to dig more holes, to provide more accounting services, to deliver more software, to send out more widgets, whatever it is. If you can say that the machine has gotten bigger in a way that is durable, then you can point to just the last year, if not even some forward-looking period, if not purely the trailing 12 months, but the current period, the time in which you had the success, that's what you want to base value on. And in order to avoid the conversation trickling into, why don't we look at the last 2 years? Why don't we look at the last 3 years? Oh, they're not going to be able to repeat this again. You have to preempt that and say, here's why the company will continue to perform this way. Now, what does this conversation often progress to is a buyer or acquirer saying, fine, I believe it, but if you believe it so much, let's bake it into the deal. What shape does that typically take? It's structure. So if number one is substantiating a difference in the sales process, number two is substantiating a difference in the execution process, number three is accepting some level of structure in the deal. And so if the transaction was supposed to be, let's say if you were to take the average of the last 3 years of EBITDA and multiply that by 6 times, by 8 times, whatever the multiple is that it's going to be applied, and you say, okay, I'm going to get $12 million when I'd rather get $30 million. A lot of times the way that will be negotiated is that we'd say, look, if you applied the same multiple or even a slightly higher multiple to just this last trailing 12 months worth of EBITDA, we're going to have a value of $30 million. They're going to say, yes, but how do we know it's going to happen again? And a lot of times the middle ground that ultimately is reached is, well, let's make the value $22 million today at closing, giving some credit to what's been done, but having some structure. But the $8 million will be in place should the company be able to achieve the same performance next year. Now, we're very, very careful, and that's where there's some intricacy here about how do you structure that earnout, where you don't want to say we'll hit the same level of profit necessarily if you're not in charge of managing the operating expenses. However, you might say, look, at the last year's revenue, we were able to extract this much profit. There's no reason why that same level of revenue cannot strain down to the same level of profit. Therefore, if we're going to say it's a $30 million deal, $22 million of which is at closing, and $8 million of which is over time, or is earned out, let's say, by a continued performance over this next year, then let's make that predicate on revenue, because if you manage the company just as intelligently, which you will, buyer, right? Let's just predicate it on revenue, because that revenue will yield the same EBITDA, and therefore we don't have to handle over what the expenses are going to be next year under your new stewardship of the business. And that's a lot of times how these bridges of valuation take place, where you're able to, A, substantiate sales, substantiate execution, thereby bringing the baseline cash at closing value significantly higher than what was otherwise going to be offered, but then getting beyond that to the true valuation of the company by negotiating and agreeing on some sort of structure that allows for you to prove out this is going to happen again, and it does happen again, and you get paid for it. So that's the notion for today. You've just had the best year your company's ever had. Congratulations, the buyers are going to want to give you a discount. How do you defeat that argument? You substantiate sales, you substantiate execution, and you include some accomplishable, easily accomplishable, ideally, structure to prove it out. And that all boils down to the process of making it more believable, making it more convincing, making it more durable. And oftentimes it is convincing, but the narrative just isn't there correctly. It's just not hitting the right things that people want to hear. So that's the thought for today. Hope the week's going well for everyone. Keep pushing forward. God bless. I'll see you for next time.